All right, yield nerds. Hope you had a good Thanksgiving. The time is now right to start looking at what is called the yield spread and understand where we are with respect to the historical yield spreads and what does that mean to your own investment strategy. Couple of usual things. What I'm offering is not investment advice. It is purely education. You make the decisions. I have nothing to secretly pitch you. I do not have sponsors. I do not have endorsement deals. So this is pure education. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. Now, how are we going to approach this topic? The first thing I'm going to do, and I noticed that some of you are new listeners and some of them are older ones, we're going to very quickly review what we have done so far. So if you are a new listener and there are some holes in your understanding, you will know where to go to patch up your holes, so to speak. Next, we're going to review how we set up the data, and this may be useful whether you are a new listener or you've listened to all the shows until now, just so you can keep everything consistent. We will then look at where the yield curve is today and understand the history of the spread. And what we call the spread is the difference between the 10-year and the 2-year, and we'll review that in greater detail. And then say, given where we are with respect to the spread, what does it mean for the next couple of months? The recap of the show, as you may remember, very early on in episode 2, we compared yield investing to tomato farming, where you can keep picking off the tomatoes every week or every day, and there is more that comes up. And growth investing like lobster farming, where you have to wait, and sometimes you don't get anything at all. And from there, we started looking at the yield curve and how there is an inversion, meaning the shorter term yields are higher than the longer term yields, which really don't make sense in the face value. And we then talked about how we could buy treasuries. We reviewed agency bonds. We reviewed munis, corporates, and preferred stocks. And if any of these are topics that you need to review again, feel free to stop now, go to the playlist and understand how you can create your own personal yield curve based on your state tax rate and your income tax rate. We looked at a couple of more complicated concepts such as de minimis. We reviewed the treasury auction, and now here we are with respect to the spread and what is happening today. In our show description, you will find the yield roadmap, and that playlist is the best way for you to follow our show. All right, let's go to our data setup. One of the things we have been doing, when comparing one kind of a yield producing asset to another, some of them are tax exempt, some of them are not, some of them are federal tax exempt, some of them are state tax exempt. So we just put the pre-tax yields for all of them. The way you would do that, since treasuries are state tax exempt, you would put your own state's tax and you bump up the yield of treasuries by that number to get a pre-tax yield. And you would do the munis, except you would bump it up by the federal tax rate. And you would then proceed to look at agency bonds where there are some nuances, and corporate yields are going to stay as is because they are indeed fully taxable. And we reviewed some nuances in agency bonds in terms of Fannie and Freddie being, public-private partnerships and not really exempt in terms of state taxes, and also exceptions in muni bonds. And quick thing about tax treatment, I am not a CPA. I'm not giving you tax advice. Make sure you get that. But we do use effective tax rate instead of the last dollar or marginal tax rate for various reasons. And you can go to some of the previous episodes and understand why. So here's what we did. We compared all of the income producing assets and we then picked off only the A-rated corporates because those would have the highest yields, only the A-rated munis because they will also have the highest yields, only the agency bonds that are state tax exempt, and we gave the best advantage to munis. And we then looked at the yield curve and we saw that even in that scenario, the short-term federal funds rate crushes everything else. And so treasuries are phenomenal in the short term, agencies after that, corporates in the long, and munis in the very long. That's what we saw. But if we look only at treasuries, we kept coming back to this concept that there is an inversion. What do we mean by that? Here is the 10-year, that's around 3.8 something percent. Here is the 2-year, that's at around 4.4 something percent. And the difference between those, which is technically, you would imagine for a longer term, the 10-year yield would be higher, not lower. And so in this case, you're going to get a negative, meaning 10-year is lower than the 2-year. And so the spread, as we call it, is negative. But historically, the 10-year yield would be higher than the 2-year, and you would get a positive value for the spread. And that is what we're going to focus on and say, why is the spread negative? What does it mean to you? And what does it mean to your income producing strategy? And if you could hold short term and get a higher yield, why in the world would you be a long-term investor? So we're going to dig deeper into that. Now, if we have a negative yield spread or a yield curve inversion today, how do you think this was historically? And to do that, we're going to go to the St. Louis Federal Reserve Bank publication of the 42-year history of the spread. And when you look at that, you're going to be surprised. And in terms of, where we are today, if you look at the last 42 years, now the zero means the 10-year and the 2-year were the same. Any number above zero means the 10-year was higher than the 2-year, and any number below zero means the 10-year was lower than the 2-year. The gray bands are recessions, and what you're going to see, interestingly, is any time the yield curve goes negative, within a year, year and a half, there is a recession. And so that is why people are sitting here saying, oh my goodness, the economy is going to go into recession because the yield curve is inverted. And again and again and again, within a year and a half, 2 years of the yield curve inverting, we've had a recession. And what is even more interesting is that the level to which the yield curve has been inverted, the last time this happened was in 1982. You sit there and say, what was true in 1982? And let's take a small stroll down history lane. In 1981, there was the Iran hostage crisis, so there was geopolitical challenges. Ding, 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 we have that today, except it's not necessarily with Iran, it's with Russia and other international crises. We had an oil crisis with respect to oil supply. In 1982, it was the Libyan oil embargo. Today, we have embargoes in the Russian oil side. At that time, the US was a major importer of oil, and that is why our economy had a big shock. Today, the US dollar is riding very high, and a good reason behind that is because we are an exporter of oil, and that's a big difference. Then you sit there and say, okay, there was geopolitical crisis, there was a supply shock. What happened to interest rates at that time? Let's review that. Here is the answer. The target federal funds rate, which today is about 4.5%, 5%, that's what the Fed talks about, was 19 to 20% in 1980. That is shocking. And clearly that was done as a shock and awe to, manufacture a recession and cool the economy, so to speak. And a couple of years later, it fell to 11.5. And by the end of the decade, it was half of that. And decreasing the interest rate has the opposite effect on the stock market. And that is why it was done to kind of create a recession, get the stock market back to normal, get the hyperinflation back to normal, and then set the economy back in course. And so if you looked at the 10-year history, 10-year rate history, you can see that in the 1980s, it was an obnoxious 15, 16%. And from then on, it has continuously come down over a long period of time. In a short period of time, it has gone up, but it generally has trended down all the way until earlier this year when it again started going up. Even so, the 10-year rate is barely a third of the historical highs that we have seen in the 80s. If you look at the 2-year rates have indeed risen measurably, but they still are less than half of what it was in the 1980s. And so, as much as you can sit here and say there is a huge reversal, it's not anywhere as high as it was in the 80s. So, it's not a replica of the 80s. And we also have all these smoke signals coming out saying, at some point we'll be thinking about it and we're going to slow it down. What is the point of all of this? If indeed the interest rate increase slows down and eventually starts decreasing, that would be a signal that the Fed is now going to increase the monetary supply. And that would also mean the economy would be stimulated. And if the economy is stimulated, the hope is that we go back to another bull run. And if you notice, right from around 1982, remember in 82, interest rates were still 11%. It was only 89 that interest rates came down to 6.75. So they were in a downward trajectory. As interest rates go in a downward trajectory, the equity market shoots up and grows very, very quickly. And so the reason there is euphoria in the stock market today is because the hope is that, the Fed is slowing down increases. Maybe they will actually start decreasing the interest rate. That's the low point, and that is why everybody suddenly says, let's get on the stock bandwagon. But to kind of sit here and draw a conclusion that you know exactly when the stock market has bottomed out is a little bit of a silly, task in my opinion. Trying to time the market never works. You have to use a whole lot more of information and a little bit of judgment and read and gather your own data. Use things like YieldNerd to educate yourself, and you have to make your own decision. If the Fed said, okay, well, we're going to slow down interest rate increases, that still doesn't mean that, the Fed has actually decreased the interest rate. It is not going to happen overnight. It is a process. And so to jump all into equities tomorrow thinking, yes, we've reached a low, may be premature, and that's up to you to decide. If the spread is this high, trying to get anything in a longer duration would be a risky proposition because the possibility that the rates would keep going up is still there. So you may want to still maintain your duration low. You make your own decision. A lot of the data that we have reviewed here comes from personal worksheets that I've developed that I'm happy to share with you. Reach out to me, and my email is yieldnerd@gmail.com, and I will gladly share any and all information with you. Thank you for listening, and look forward to sharing more information as I gather it with you, and look forward to learning with you. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.